Traders, welcome back to the final hour just after 3 p.m. May 5th. Happy Monday. Thumbnail, earnings on tap. 1,255 companies reporting this week. We got a lot of the Mag 7 out of the way. We'll take a look at those. We have lots of others. So your kind of market breadth. Is this a rally that's going to be continued? We have the Fed this week. Are we going to be running into some resistance? I'm a little skeptical of these highs. I took a lot of profit the last couple of weeks, as I've talked about in these final hour sessions. Ended up getting to about 60% cash in my portfolio last week. So have some income plays, have some earnings plays. Some of those will include, I pulled some notables out. I sent this in my Telegram channel earlier. Some tickers that may be of interest. Let's go ahead and list these out. Stocks to watch for the next maybe 30 days. Could be this week, could be the next 20 to 30 days, but I'll just start a list here. Ticker APP, UPST, SYM, LMND for lemonade, SMCI, IONQ, CELH, TTD, Rocket Lab, RKLB, Pins, Crocs, Toast, Expedia, Zillow, DraftKings, and MTCH. I think it's Match, like the dating app company. So we've got some technical setups. We have some earnings sensitivity on each one of these. So that's a decent list. We'll take a little top-down stroll. But I have a trade-in for app on my newsbreaker service, Upstart on my newsbreaker service, Bill on my newsbreaker service. I'm pricing out some other ones for the remainder of the week. We have some other ones that I'll be looking through. I'm not taking a trade on HIMS, which has earnings this week. I'm looking for potentially Shopify, and then I've got about halfway through the list today, so I'm going to keep grinding through it. A lot of the earnings still on the Wednesday, Thursday is kind of the meat of the week, and then I'll decide if I want to take expirations for this Friday or out to next week, which would be, I believe, the 16th. Yeah, 16th would be next Friday. So that's where we're at. Let's take a look at the bigger picture. Go to the S&P. Everything is just slightly red today. Here's intraday movement. Earnings sell trades this morning on SPX daily profit play 2 for 2. Had a nice little winner in the morning, and continued to look pretty good late in the day. But this is done and over. Market did what we needed to do. We had ISM numbers this morning for the U.S. Came in slightly positive. News tomorrow, pretty light. So low impact day. Fed is on Wednesday. I mean, it's kind of a lull in the economic impact outside of earnings. So we are at a pretty key level of resistance. Today being a little bit lighter, I could see the market just kind of quietly humming along. Maybe the Fed gets some noise this week, for better or for worse. Maybe the Fed sets the tone for something. I wouldn't be surprised if the market has a bit of a backfill to these recent gaps as the market melted up. We're nearly off the lows, about 18%. So looking at this low to current level from Friday's highs, about 18% on the S&P. Is it possible for this market to melt up a little bit more, let's say into 5,700 or so, before we have a pullback? Let's zoom in on a 4-hour chart. Just kind of noting some gap levels here. So potentially a gap, and potentially a gap. So, if the bears are going to claw back, they certainly have some liquidity levels to fill. You can see this also in the futures market. It's obviously more pronounced when you have gaps from opening bell, closing bell, pre-market, post-market. But a pullback would make some sense. I would be interested in buying dips. I talked about this a lot this morning. Somewhere between 5,500, maybe a test on the more aggressive side. And if I want to wait for a bit of a better entry, I'd probably be waiting for like a 5,350 or 5,200 zone, somewhere in here. So 5,350 to 5,200. And obviously, if it goes lower, then I would be looking to add in positions, near the bottoms and trying to carve out kind of a double bottom position. If we have a look. Let's say the market's able to melt up a little bit higher before we get a pullback. Um, Again, pullbacks would be backfilling some of these gaps. The bull setup would look pretty promising. Um, I do wonder if I would be courageous enough to kind of call the right shoulder on a setup like that, or if I would just wait for confirmation, make sure this market can get to all-time highs, and then we start making that run above 5750, 5800, running into 6000 or 6100. That to me is a bit of an easier trade with more confirmation, just in case this market is going to do something like this. Say it comes up here, comes back down, and it looks like a good spot to be a buyer, but then the market uses the backside of the trend line, continues to claw back into these April lows. I just don't want to get in too early. Although the upside, if I was out longer dated, 12 to 24 months, then sure, it wouldn't be too bad. Just look at defined risk. But I'll position that when I think it's appropriate. So anyway, that is that for now. That's S&P. NASDAQ, here are the Qs. Here's NDX. Kind of the same thing. If we looked at some gaps to fill, gaps in here, gaps in here, gaps in here. If you zoom in a little bit more, let's say a 1 hour time frame, get rid of some of these moving averages, but just look at this level. Draw a trend line. This market can basically stay supportive. I wouldn't get crazy bearish unless you're trying to call the top for a near-term play. I did short the market on Friday before the close. That was a trade on ES, and I'm happy that I did because it was a trade that I shorted at 5,700. Let me go down to I guess this was it. So I shorted it Friday at the close, which should have been over in here around 5,700. And we ended up going down to about 56. So I closed profit like 20, 25 points on it. Grabbed some profit on Sunday when the market opened back up. I think I might take another stab at a near-term short this week. I'll just trade some futures action. It might also be, like I said, a very boring week until we have the Fed on Wednesday. And Fed days are difficult to trade. I'm sure you've all watched it, but the excitement happens usually after 2 p.m. And then from 2 to 4 p.m., things are crazy. The market goes up, it goes down. It's a very noisy day typically. We don't see a lot of direction. But the 2 o'clock news is going to be a pause. It's pretty much baked in right now that the Fed's not going to do anything. So go to the current probability, 97.6% the Fed doesn't do anything on Wednesday, and then go into the press conference, and that's at around 2:30. Powell will have a statement. He'll take some questions, and he'll probably see some we'll see some headlines drip into the markets. But looks like right now the Fed is just going to pause May, pause June, and then possibly issue their first cut in July. I am very curious to see, and I've talked about this a lot. I'm curious how the 10-year and 20-year yields play out with the Fed rate decisions coming up, right? If the Fed cuts rates like they did last year, the market did not respond in typical correlated fashion. So if the Fed starts cutting, and we may not know this right away, I don't know if the messaging that Powell's going to give us on Wednesday is going to give us any type of movement on the yields, but certainly I'll be watching it. If the markets don't seem to like it and the yields spike up, we might be heading up into higher yields, and that is going to put a lot of stress on the growth side of things. But if it resumes, and maybe this was kind of a one-off outlier, and all of a sudden the Fed cuts and 10-year yields continue to go down to where we saw this, Liberation Day announcement, maybe that's the case. If we're lucky, we'll see that for the, 10, 20-year yields. We'll start to see the long end of curve going down, but time will tell. So I think there are concerns that the market, could have, and this could be like the preview is, basis trade breaks. You have bond premiums. The risk to trade in bonds and the liquidity in order to continue to fund the U.S. debt, it could come to a screeching halt. And I'm sure there's going to have to be some emergency measures. And I unfortunately don't think that the markets just kind of fix things gradually. I think that usually the market reacts to chaos. As you can see this year, that Liberation Day announcement was pretty chaotic in the market, had a nasty couple of days and then snapped back to reality. Same thing would happen if we did have a bond market break. I'm sure there's going to be some some backstops. I'm sure there's going to be some emergency measures that take over, but it's all about surviving through that as opposed to trying to necessarily call it and trade it. So I'm watching. I don't think the Fed is going to do anything for a couple of months. Even to the chagrin of Trump and the White House being vocal about cutting rates and saying it's time to cut rates, and they're behind the eight ball and they're always late. It's like, well, the Fed's always late. They're always late. They're always reactive. It's no different. It's no different now. It's no different ever. The Fed is always going to be a reactive body. They're supposed to be independent. They're supposed to help provide liquidity and price stability. Their mandates right now, it's focused on inflation and labor and price stability. So, I mean, it could be worse. We could have a Fed that's going to make irrational decisions and bow to the pressure of a vocal president. And I mean, I don't know what that does to price, but I'm going to hopefully just kind of trust the markets and make sure that things stay relatively stable. Here's a good way to look at it. Through Liberation Day, these are junk bonds. So your high yield bond comparisons between like triple A's, triple B's, triple C's, credit spreads were very, very wide, kind of blowing up a little bit, during Liberation Day, but things have kind of snapped back into a tighter credit spread market, which is good. So there's more liquidity, things are stable and slowed down, which is encouraging. LQD kind of the same thing, a little bit of disruption, but it hasn't broken out and busted loose. We talked about this morning in a session. Some trends we should be keeping an eye on for 2025. Everyone's worried about the recession. Everyone's worried about increasing the probability of recession. I see some very smart people out there calling. Originally they started at like a 10% probability, now it's up to 30, 40, 50. We've seen some as high as 50 to 60% recession. Sentiments also is very, very bad. AAII sentiment is 10 prints above 50%, which is the worst since 1987 when that entire survey started. So until, I'm curious, like if the market will melt up because the pain trade is more upside, right? More upside produces more FOMO. More FOMO gets people off the sidelines. And they possibly get into the worst time, but maybe the market has the path of least resistance and continues to grind higher. I still think dips are coming. I'd like to see a dip or two that I could actually position for the long side. But if it just melts up higher, it will be basically a rally that feels like you didn't have a chance to participate unless you timed the low or called the low shortly after the tariff pause on April 9th. You really didn't get a chance to participate in much of this rally. If you take a look at the S&P, a lot of this rally, for example, you had maybe 3 days worth of real rallies here. You had one on the 9th, okay, and then you had a huge gap up, and then you essentially had like one follow-through day, right? Like this was a follow-through day that then gapped higher, but you had, I would say, between these last 2 or 3 weeks of trading, one ridiculous move that set the posture, and then 1 to 3 follow-through days to get your push, and that was it. So if you weren't paying attention to this, all right now is that the market was all-time highs in February, and here we are, just down a little bit by about 7% off the all-time highs. That's what you know. If you do pay attention to this, you know that there was a screeching halt to the global trade and a lot of disruption, and it really was probably more of a bluff to get China's attention and thinking that the U.S. flexes its muscles and the world rolls over, but it's not the case. I think China is willing to play hardball a little bit, as is the U.S., but ultimately, we're going to find out that we probably need each other more than we're willing to admit, and the optics remain that we're going to be frenemies, but we got to find out. Hopefully a way that the global economy can move on with as little friction as possible. Both sides are enhanced. You're going to see more wealth, more deflation if global trade is free, and I get it. I mean, there's pros and cons to what happened. I think the way that it was administered and rolled out was pretty careless and reckless. But it makes sense that China's a tough trade partner and can be a tough trade partner, and they have a lot of leverage where they don't really want to budge. So anyway, it's not over yet. But I'm a little bit less bearish in this case since the market did recover. Obviously, I'd be a little bit less optimistic if we were still sitting here at this resistance level and the market rejected right away. But since we are now back to the 200 moving average, Maybe now the market is waiting for a bit more evidence to say, okay, let's justify going higher. But in that area, we could be dealing with some noise, and I fully expect that noise to kick in. This is a good week for it. The next couple of weeks are good for it. I don't really see any crazy volatility happening. The Fed's not going to surprise the markets with much earnings wise, as long as the earnings come in relatively decent. Mag 7 is solid. The AI spending is still happening. I think that there is a bit of an edge looking at tech and high margin, less labor. I mean, all these things looking out 3, 4, 5 years, 10 years. If you don't need to rely on human workers, if you have margins, you have cash, I think you're positioned for a pretty good run in the next 5 to 10 years. Those are stocks that I'm interested in getting a hold of. I mean, a lot of that is basically try to find as many Mag 7 like companies as you can. But if you can find a Mag 7 company with lower price to earnings or a lower PEG ratio, get it for a better discount or have more runway to gain and earn. That would be probably the best way to look at some fundamentals. If you're looking at certain sectors, I think that the communication services probably does well. Tech will probably do well. As long as we have risk appetite, tech will probably do well. Industrials, possibly. Industrials, basic materials, possibly. Financials, I keep hearing that financials is going to do well. I don't know why they necessarily would do great. I mean, if you look at XLF, for example, XLF, I mean, yeah, it's come back a nice chunk. But I mean, maybe to the upside. I mean, how many sectors are actually up for the year? Let's go to sector performance. See what's up year to date. So anything year to date, we have got the S&P down about 3.3%. Consumer staples is up. That's a bit of a defensive positioning through this first part of the year. Financials actually are up, not leading the way, but utilities, interesting enough, leading the way. So, I mean, utilities is pretty heavy on a couple of big companies. So, Southern Co is 8.17% of the sector, and it's up 10.6%. You got Duke Energy Corp as well. These aren't really cheap. They're not super volatile. If you take a look at SO, DUK, we'll come back to this in a second. So go SO for Southern Company. I mean, I'd like to see a range trade if possible. I mean, if I'm going to participate in a stock like this, I'd like to see a range trade, maybe coming back down into the low 80s before I start to position for it. So, I mean, we have a bit of a dividend, 3.25%. It's lower beta, 0.02, so it's not necessarily correlated. Are we going to just have gangbuster, utilities going higher? I mean, these stocks don't really move like that. They're mostly defensive, So if we have a range, I think, getting long in here is a good spot to get long. And just respect the price appreciation by maybe grabbing $8 to $10 a share if you can time this well enough. If you wanted to hang on to it, you want to buy some here at 90, buy some here around the low 80s if it's offered. Obviously if the price goes higher, that's good. If the price comes back down, chunk 1, chunk 2, couple of dollar cost average positions, maintain a bit of a dividend, non-correlated to the S&P. I think that could be pretty good. Robotics ETFs worth investing in. I'm sure there are some. I would do some research on them though. I'm not just buying the hype. I mean, I know same thing with semiconductors, right? You had SOXX, you had SMH. Basically, it turns out that it's mostly just investing in Nvidia. So there could be some robotics, but it's still so new, and a lot of the humanoid stuff is probably private sector at this time until there's proof of concept, proof of revenue, and then it starts to get more mainstream. Yeah, I think let me see if I got a screenshot here. So introducing the humanoid 100 Morgan Stanley. So here's an example. Here's some stocks that might benefit from this. We have brain and body. So Morgan Stanley's list of global humanoid enablers. Baidu, Google, Microsoft, Meta, Nvidia, household freaking names, right? Data sciences, analytics, Palantir, Oracle, Microsoft, Meta, Alphabet again, semis, Intel, Nvidia, Qualcomm, semiconductors, Micron. I've got some positions on Micron, Samsung, designers, ARM, Synopsys, TSMC, Intel again. Then we get into some, actuators and actuator parts, some sensors, batteries. It's like it would be nice if there was, and don't be surprised if there are, brokers like Schwab, like JP Morgan, like I'm trying to think, Pro Shares. I mean, you start to see a lot of these ETF structures. I wouldn't be shocked if there is some type of like robotic slash AI based, basket to trade. It does make trading a lot easier. You can spread it out. They can kind of have a mix of all these companies. Maybe they're weighted, maybe they're not. But yeah, I mean, we'll find out. Integrators, Tesla, probably one of the biggest ones to, I mean, I don't think anybody, if I ask anybody, look out 10 years and what do you think a Tesla factory looks like? I think most people would agree that Tesla's probably going to be one of the companies that is running with almost a zero human workforce, and I know that, I mean, for the future, it's like, yeah, I think Tesla's way more than an auto company. I've said this, I think is a huge disruptor in the industry. And then you put in the AI space, chips, energy, robotics, AI, humanoids. I could see Tesla having lots of upside potential. And it looks way more attractive now that we've had a 60+% shakeout. That was down from peak to trough about 55%. So I think Tesla has good positioning moving forward. Amazon distribution, warehousing. I mean, if we start seeing less drivers, more drone deliveries, who knows? If they start doing autonomous delivery vehicles and freight, who knows? Apple probably needs to get its stuff together and have a less reliance on China. But Apple, I think if they do anything in the world, they can do it really well. They don't have to be first to market. They can just do it well. They certainly have the cash to position themselves however they want. Samsung, Rainbow Robotics, LG, Sony, automakers, Toyota, Hyundai, Tencent. That's Chinese based. Tencent Holdings. I mean, if you like the game Fortnite, I think that's still Tencent Holdings is their parent company. Foxconn. Yeah. So anyway, if you like take a screenshot of this, you'd like to just get a list. I mean, and like I said, this is a lot to take in. But at the end of the day, this probably still benefits Mag 7. I think Mag 7 also, to maintain a competitive moat, will probably buy up a lot of competitors. We might not see a lot of companies go public in the next 3 to 5 years. If you have, the ability to leverage technology and you don't have a lot of labor overhead, a lot of companies could probably have a 50 to 100 plus $1 million market cap or valuation and never have to go raise capital in public markets and never have to be worried about like quarterly earnings and making shareholders happy, but rather just be a big enough threat or have some type of edge where you get bought out by a big company. And I'm sure that whole idea of mergers and acquisitions are alive and well when it comes to, if you got something we like, there's always going to be somebody looking to buy it. You know, I mean, Meta's done that forever. Google has done that forever. They've essentially, I mean, that's why they're always going through government probes and antitrust uh, cases, because they just squeeze out competitors because they just buy them out. But for those that create those little competitors, it's a nice payday. Then you go find something else. So anyway, that's an interesting kind of mix. But like I said, give this 12 to 24 months, so this starts to really get some traction. Then we're going to see ETFs get created. You'll see your major ones. You'll see a Schwab ETF. You'll see a JP Morgan. You'll see whatever. I mean, there's all sorts of ETF based companies, or just the custodians. So anyway, I'd look for like a fairly low, like BlackRock as well. I mean, you'll see low expense ratios, but what I want to look at is, what is it? Is it just a conglomerate of things that are like, this is everything AI, this is everything humanoid, this is everything robotics, or is it very specific? I think that the hard goods versus soft goods, or the hard goods versus technology, could be very different. I mean, I don't know if it's going to be as bad as like spot price on gold versus miners. Very different performance. Spot price on gold has crushed it these last few years, and miners are just starting to catch up. I don't like I don't like investing in mining companies for gold, silver, and commodities. Their overhead is super high. Their projects are super expensive. They take years to develop, and they probably have such a low hit rate as far as start a project. Does it yield what's needed to generate money? Even though spot prices at crazy all-time highs, it's still a very expensive undertaking. So I just like trading the spot price of gold, spot price of Bitcoin, spot price of silver. Not that interested in the mining side. So anyway, something to keep an eye on. Okay. COCO, is that just that's just the commodity, yeah? You're talking Vita Coco, like coconut water? Yep, it sure is. $25 up to $35. That's not bad. Up about 36% off that low. Let's have a look here. Let's go. COCO. Vita Coco. Huh. I mean, snowflake analysis is pretty good. Well below estimated value, earnings forecast to grow. Earnings are growing. What's the price to earnings ratio? Bit on the pricey side. See how it compares to its peers, but has some good upside with the discounted cash flow model. A bit more expensive compared to other beverage companies. Coca-Cola 17.5 price to earnings. The non-US based Coca-Cola 16.2, National Beverage 21.7, Vita Coco 32x. Celsius Holdings has earnings this week. That's the crazy fruity all natural energy drink. 82.7 price to earnings. I've had one Celsius in my life, and it was on a road trip, and I stayed up until 5 in the morning. So I think I'm good on no energy drinks. But anyway, yeah, if you're in some cocoa, you're having some fun with it. Euro dollar, uranium. I do have some plays on uranium, URA. So I'm this. We got a nice little bounce around the $20 handle. I'm just holding. I was in this area here. I was pretty aggressive on some diagonal calls. I was aggressive on some buy some buy levels. Basically, I started this whole trade back here. So when we had a lot of support on URA, then I was buying it around 20 bucks, shot up a ton towards 32. I scaled out half my position, and then I was waiting to see if I could buy, a halfway point. So I added some more. Over here, I added some more, and we did come down to 20 bucks again. We shot back up. So I am long on uranium. I'm not really that excited about it unless it gets back above, I'd say about $28 to $30. Really excited about the potential of running up into the mid to high 30s again. From a wave cycle, I mean, this is one big impulse. I'm still looking at a symmetry trade up into the 40s. So for the shares that I own, which I do have some shares of URA, I'm just looking to hold them until we get into the 40s. So right now I'm down, but it's just a bunch of owned shares and some long calls out to January of next year. So if we get a commodity run in 2025, that would be somewhat exciting to turn these calls into some profit and have some shares to show for it. But that's it for right now. If we come back down I will say this, if we come back down to the lows again, I'm going to move this chart alarm back to the lows. Set this chart alarm around $20.25. If that activates, I'll add another chunk. I'll probably throw in another, half position and add up to 100 plus shares for my holdings. So I've got over here, where'd they go? There it is. So right now, I'll just average these to 50. 1, 2, 3, 4, 5, 6, 7. So about 350 shares of URA. And I will probably double that if we come back down to 20 bucks with put protection just in case. But if we are seeing a bottom, maybe a bullish pattern in here, if we get back above the 200 moving average, it'd be nice to see some of that. Just a chance to revisit lows, bit of a shakeout, and then we'll see if there's a bit of a run. I mean, even if it's a range trade, honestly, like if it's a range trade back up to 30 and change, back down, up again, that's okay. I will kind of ride it out a little bit. What do you see in the VIX the next few days? Your guess is as good as mine. I mean, the VIX has been one of the biggest retreats we've had in history. We had, I think, the third or fourth largest spike in VIX history, followed by one of the biggest single-day crushes in VIX in history. Here we are into the the low 20s. I think right now, just because I'm looking for a bit of a pullback in the markets, we're probably going to see a slightly elevated VIX. I wouldn't be shocked to see the VIX go back into the high 20s, maybe 30ish. Just for a bit of a pullback, but maybe still kind of containing the markets in here. So I mean, this would be trouble in paradise if we're above 30 again. Like what news is following that? I don't know. Did Trump say something? Is the Fed going to make a policy mistake? I don't know. But I think that after this kind of reaction, I'm not going to call it an overreaction because this was as potentially threatening as the Great Financial Crisis when you're going to freeze the entire global economy on a trade war. Um, but now we're kind of settling back into the markets are probably a little bit more tame. Expect some higher elevated volatility, but if I'm going to get long VIX, it's going to have to be like low teens. I mean, I'm talking 14, 13, 12. Then I'll play long VIX for like a 30 to 60 day move. Otherwise, nothing crazy. But maybe a little bit of an up move. I would just say we probably still cap it around $30 though. I think the VIX it'd be difficult to see it raise, rally back above $30 to $35. Euro dollar, yeah, I talked about some currency pairs this morning. Here's the currency chart for the day. Japanese yen was on top today. New Zealand, Swiss, and Aussie just above the baseline. Pound, euro, CAD, dollar. Dollar CAD were weakest this morning around 9 a.m. They've come off those lows a little bit. So not a ton of volatility in the currency world, but dollar index, that would answer your euro dollar question. I'm still looking to see if the dollar index will still pull back. So I'm looking for a bit of a pullback here on dollar index, which means a trend line break to resume selling. If you're looking at euro dollar, I actually don't mind a short position on euro dollar right now. But if you're short euro dollar, it is short term, meaning for some certain targets. If I was short euro dollar now, area one, I'd want to short it again at the top, and I try to get this thing at least a range trade, or if it comes back to a 30, 38% fib, 50% fib, I mean, that would be moving stop losses to break even, moving stop losses to trail, probably closing out the position entirely if we came back to like a 50% pullback. So if I'm willing to sell it, sell some here. If it goes down, take some profit. If it goes back up, willing to sell at the top. Halfway in between, if you took equal trade sizes, that's your break-even point. If the market, hits the top and comes back down to range lows, that's your break-even. You can still take some profit and grab a couple bucks. So I think the dollar index is due for a bit of a pullback in the near term. Levels on dollar index around like 112 or 102, like 101.50 to 102, which if that equates to the DXY, euro dollar correlation, then probably a pullback to like 111.50, 110.50 or so on the euro dollar. Okay, makes sense. Let's see what else. I mean, we did kind of top down. I mean, the non-US plays are they're still in the go zone. I mean, I was really shocked this morning to see that the German DAX is, I mean, almost right back up to all-time highs. I mean, what a crazy dip and bounce. It's still, I mean, for the year, if you go to the 12-month candle, I mean, this is the yearly candle. It's one of the best running indexes for the year. So we opened. I mean, DAX is up 17% year to date. There's not a lot of countries right now that are that. I know if you saw that, I shared this Bloomberg terminal screenshot maybe 3-4 weeks ago. It was before Liberation Day. It was for tariff talk. It was for trade war. But like every Eurozone ETF was up like 15 to 25%. There was some that even up like 25 to 30%. The Eurozone repatriation has been really, really strong, and you can see the resiliency on this daily time frame. Basically, we broke the world for a couple of days, but you can see how reflexive that was to see where that money is going. There's still a decent amount of flows going non-US, and DAX is a good way to participate. FTSE also climbing back nicely, back up towards the highs. I don't like Argentina as much because this has been a good performing ETF the last couple of years, where the German DAX was just kind of garbage, just kind of slow, like a slow build. And then we started to really accelerate here late 2024 into now. But man, what a wild drop to rally. I mean, this was down 21% and then right back up to the tops again. So that's been a rip of around 26% to catch back up. It's still up 17% for the year. I'm participating in the DAX by buying FEZ. So I have some ownership and some options on that. EWZ, I still like the value play. This is also a non-US. There's also ways to participate in this without just buying a bunch of ETFs. So I do own EWZ. I do have FEZ, but SCHY is a non-US ETF for Schwab, and it's pretty cheap. It's like $20 some, and you have mostly exposure in the Eurozone and China. good enough. I mean, if Eurozone's going to run 25, 30% for the year, China's going to be resilient as well. If US and China comes to terms, I think China has a lot of upside. It's a good, to me, China is a good trade, not a good long-term investment. It's a good trade. So I'm German. I still don't trust the tax. I mean, that's understandable. I mean, I think the problem is it's still very much tied to the success of the U.S. I think right now, because the U.S. has been performing better and it has bounced off those lows, I think this just shows that, yes, it is doing well. There's a reflexive move to it, but there are some serious flows that are coming back in. I think the reason why it is up as high as it is the Eurozone has been basically Mr. Scrooge for a long time. The Eurozone is full of austerity. They don't like fiscal policy. They don't like operating at deficits. And now that is changing. They're putting in, $500 billion or like $500 billion to $1 trillion plus dollars. There's defense spending. There's infrastructure spending, and that's a big deal because how is the U.S. The definition of American exceptionalism has really been because both Democrat and Republican parties for the U.S. have added to the deficit. So fiscal spending is huge in the US. And, now we're saying it's a problem, but I don't think we can get out of it. I don't think it's going to stop. I mean, clearly, if Trump really wanted to stop it, we'd have a full on trade war and we would crush the economy. But we're not stopping it. Like, there are breaking points, there are circuit breakers, and the bond market said it. The financial markets, you can see how powerful they are because the complete tone of Donald Trump and the White House administration, the complete tone has changed. Since April 7th, April 8th, April 9th, the complete tone of the White House has changed. It's done a 180. So when you're looking at countries and zones going non-US, I mean, Germany is spending money now, fiscal policy. So I don't know if this is just everyone spends until they can't, everyone spends until the whole fiat system blows up, or there's ways to restructure. I mean, I read this interesting article over the weekend on private equity. Like, debt isn't usually repaid, it's refinanced. Does that make sense? So, I mean, the constant flow of debt and refi is a big deal. And I know that is a potential obstacle in 2025. If we have, yields higher in the US and global yields higher, refinancing debt is going to be a problem, especially as deficits grow, as debt to GDP ratios grow. But it could be creative accounting. I don't know if there's going to be a crazy financial reset. Probably not. But things could get ugly. But we know how long this can get kicked down the road. It could be kicked down indefinitely. Because there's clearly a lot riding on it. You cannot stop it, but the deficit must be reduced. Yeah, but who's going to do it? What politician is going to opt for austerity and still get elected? Nobody. Right? I mean, the closest thing we've had in the U.S. is Donald Trump, because as a campaign, he said we're going to fix the economy. We're going to help Main Street. We're not. It's the same thing we've always been doing. All we did is we had a very disruptive way to say we're going to put some tariffs out there. And it really was the whole target, the whole crosshairs was U.S. China the whole time. But we blanketed it and got the world's attention, and then from there we're trying to kind of negotiate certain deals, and whoever gets in line with the U.S. and whatever. But I don't think it can be stopped. I think it just has to be curbed or realigned, or there's got to be a parallel system. There's got to be something where you can have deficits run while something is deflationary running alongside it. That's the argument for Bitcoin. That's the argument for gold. That's the argument for not relying on the U.S. Dollar as much as everyone has for all these years. To be determined. The run over the past 2 hours was crazy. Didn't see 3% today. In what? In the DAX? Japan's threat, Trump saying no China talks this week had an impact. Yeah. What's this 3% you're talking about? 3% of what? I mean, I'm not seeing any major movement today. Anything? I mean, talking individual stocks. We talking what? Where's the DAX today? DAX only up 1% today. Gold, I know gold's had a pretty big day. Yeah, I mean, gold's up 3% for the day. Yeah, I mean, gold is up. And it, I still will say this. I mean, I think silver is a better trade technically, but gold is getting all the love right now, and gold might be a bubble in 2025. I mean, this might be a trade where gold runs so far, so fast, so hot that it breaks, but it could be an exciting run. I mean, I've never seen gold higher than a run like this, and this was a la 2009 to 2011. We had about a 30% stretch away from the 200 moving average in 2009, 2011. We went almost 620 bars, 630 bars, and right now I think we're crossing over 400 bars in gold right now. So I mean, I do think inevitably we're going to have a correction. This is the last time we touched the 200 moving average. So we're sitting around 398 bars. It's crazy to think that we could almost, go 1.5 times that and get to 500, 600 bars before this thing snaps. But with a bubble, I'm just wondering, does the bubble get gold into, 4,000 an ounce? Do we check that mark? Does it go to 5,000 ounces? I mean, and again, everyone thinks about this like, oh, this is so great. Is it though? If gold is going to go into a straight bubble, this is going to have dire consequences for a lot of things. The dollar is going to be falling off a cliff. The U.S. bond market's probably going to be all over the place and super volatile. U.S. stocks would likely be volatile. I mean, everyone thinks if you're solely focused on gold, then sure, you can cheer that on. But the systemic risk around the world and around all these different instruments that are interrelated with something, you have to have some stability. Bubbles are not good. I mean, they can be great as a one-time profit. They can be great when the bubble bursts and the market drops, but the consequences we would have on gold running to just ridiculous, like I don't even know how to measure gold. I mean, if we cleared 4,000 easy, if we cleared 5,000 easy, I would just be waiting for like a top to form. I would feel like an idiot trying to call the top because that's silly, but at some point it's going to break. So I'm hoping it doesn't happen. I mean, honestly, if you here's what I'll say. How many of you had a great time trading through March and April? Great time. Like how it was like easy peasy, just made a killing. Probably nobody. Unless you're like a one position trader and you only focus on one thing and you do okay, that's different. Like I run a fund, I have a portfolio, I had a ton of crap going on. It was not an easy time to navigate. I survived it. I did okay. I've got double digit returns to show for it, but it was not fun, nor was it pleasant. Liquidity was a little light. There were definitely wide bid ask prices. We had crazy daily trading ranges. We had intraday swings of 2, 3, 4%. But I would imagine that most traders didn't do very well until after the fact, right? If you had the courage to, sell some premium, take some stabs at some of these bottoms when the market was down 20%, you probably got rewarded for it. But in the moment, very difficult, and I run like a pretty tight portfolio. I have a little bit of a tilt, but I mean, man, with options alone, I had a lot of volatility that was changing, like kind of overnight. So, but I mean, I had plenty of dry powder, and like I said, I survived it, but it was not fun. If I had to revisit that again multiple times in 2025, that's not fun for anybody. Like people make mistakes, algos make mistakes, quant make mistakes. You can't pivot hard enough. Um, you'll it's you can't position for chaos. You can hedge for chaos, but you can't position for it. You know. So anyway, I just think that if the market is relatively calm, I'm fine with that. If the market, throws us a little bit of a break, I'm fine with that. If gold starts to, really rip higher, it's like it's exciting, but it's crowded. Mag 7 was crowded. What did it do in 2025? It corrected 33%. Gold is crowded. Right? Now the retail crowd is starting to really take notice of gold. Okay. Well, were they probably buying it? Here, now, at the highs, as opposed to when this bull market started years ago. And 2023 was really the bull market setup in gold. That's below $2,000 an ounce. You know, So I'm not excited for this like this last little stretch and like this long in the tooth run. Now, if we get a pullback, then yeah, I'm way more excited. A pullback into gold, find some corrective levels, then let this thing resume like a healthy bull market. All about it, right? But a bubble, it's like all I know is that I don't want to call the top. So if this thing gets bubbly, I'm not calling the top. But what I will be doing is starting to move stop losses and take a profit just in case it does crack and it does break and then it corrects. I don't want to be left up here with no profits to show for it, and I certainly don't want to be left with no profits and even back into flat positions when at one point in time you could be up really really nicely. So the good thing is my gold positions are back here, and I'm just kind of trailing along the way. I still want to add more exposure. I think gold is still good long term. But what I can't see on gold is where the heck is the top. What I can see on silver is we have highs we've been to before. We've been to the 2011 highs right here, and we've been to the 1980 highs, same price, right around $49. So silver, I hope at one point, whether it's just a big range right now, if silver breaks this level around $35, $36, there's not much stopping silver until we get up to 50 bucks. So, I mean, as far as a measured move for me, I like silver a lot more than gold. It's cheaper, it's industrial. It doesn't have to be this like, literally like pun intended shiny object to trade. Um, and it's not in a bubble. I mean, there's technically like a lot of support on silver. I just want to see if the gold to silver ratio can come back into a balance because gold is had the upper hand here for the last couple months, right? Yeah. So as I suspected, gold going up is not going to be good for the global economy. It's going to have a lot of consequences elsewhere. And like I said, it's good for the safe haven. It's good for the risk off. It's good for the potential hedge or protection a little bit. But it's. I mean, honestly, if you look back at history on gold compared to the S&P, it's never been a hedge, right? Like it's never been a hedge against inflation. It has been a decent hedge against the S&P though. If the S&P is down, gold tends to go up. And we certainly saw that this year where, S&P is down, gold is up. S&P has recovered a little bit, gold is still up. There's still a heavy amounts of bidding to keep gold, interesting. Bitcoin. Bitcoin, I mean, I've got all the enthusiasm in the world to see if Bitcoin can go higher. My allocation will hopefully pay, the dividends. And the reason I've decided to do a 3-5% allocation is because it has lots of alpha. If it produces, I mean, also, I don't know if you saw this, but the standard volatility on Bitcoin has gone way, way, way down. Like right now, the volatility on Bitcoin. I'm trying to think if I saw oh fudge, maybe it was. I think it was a newsletter that I read this morning. But the volatility on Bitcoin has been cut into like a third or a quarter. Like it's way way lower than it used to be, and I don't think that's a bad thing either. Now I think BlackRock might have a lot to do with that. They've securitized Bitcoin. We got ETFs now, and there's real money allocations. You've got institutional flows now into Bitcoin. You've got retail. The retail crowd's been heavy on Bitcoin for a while. Obviously, the retail crowd kind of flows with risk appetite, risk on, risk off trading. But institutional flows, I think that a lot of buy and hold Bitcoin is happening. I mean, for somebody that has a 100K portfolio and you put $1,000 into Bitcoin, which is 1%, that 1% can still perform very well if Bitcoin doubles. I mean, you get like a 2% buffer if it doubles, right? And it helps, outpace the S&P a little bit. The S&P just maintains its, 10, what is it? 8% a year, 10% a year with dividends and everything. But Bitcoin could potentially be a 1% allocation generates, 4, 5, 6, 7% gains. So anyway, we'll see. But I have about a 3 to 5% allocation. I have a decent amount of my retirement also in Bitcoin, as well as, active trading like I always do, but kind of the buy and hold and long-term stuff. I mean, I think Bitcoin is a big trade for the future. I mean, if you also like robotics and humanoids and a better currency future and more decentralized and less power for the U.S. dollar, I mean, Bitcoin is that too. I don't like the meme stuff. I don't like the altcoins. I even dumped all my Ethereum. I mean, honestly, I'm just in Bitcoin right now. So, because I played the alt stuff, last 5-6 years when it was popular, but I also treated it like a trade. I wasn't hodling. I think my best return was, I don't know, like a 10x profit on Ripple back in the day. But I took those gains and put them into Bitcoin. I had some Bitcoin, some Ethereum, some BAT, some Gemini, some whatever Litecoin. But I got out of that stuff before like the 2022 deleveraging. So it's mostly Bitcoin now. All right, let me ask you this. Is anybody surprised that the S&P is selling off? I mean, if you've been to any of my sessions, the last week, what did I say? Where are we running? We're running right into resistance, man. This is so obvious to see, like, near-term resistance. I'm not saying like, oh, I called the top, because I didn't. But stretching back the 200 moving average, coming back to this level, coming back to a measured move, I mean, I could completely see like this market is going to struggle to make like dramatically higher highs. So if we are going to fade a little bit, there's gaps here. If we're going to get worse, then obviously there's gaps lower. That would be interesting. And there's all sorts of gaps, right? Let me take a look on the 4-hour chart. I did this earlier. Yeah, there's some notable gaps right here. So there's a gap to go after by the bears. There's a gap to go after by the bears, and there's a gap to go after by the bears. If anybody watches supply and demand levels, you look at liquidity pockets. There you go. Market could totally turn over on itself and work its way back down. I'm curious on a percentage wise. I mean, let's say we pull back into 5,500. Well, I mean that's decent. I mean, this is a little range here, so yeah, 5,500 would maybe be like a shallow retracement. Okay, shallow retracement in this area. If it gets a little bit nastier, we come back down and fill this gap. Well, we're talking 54 to 5,300. Not a bad spot to take a nibble if this market's going to bounce. Obviously, it gets a little bit scarier if we're coming back to this 5,200 level, but I'd still take a nibble. And at the lows, I'm definitely taking a nibble. So I'm not saying we're going to go all the way back down. I've seen a lot of analysts talking about, oh, we're going to retest the low. It's going to be a W. It's going to be a double bottom. Maybe it is. But I think things would have to turn really bearish again. Like the narrative would have to get really pessimistic again for this market to really, really drop with some momentum. This momentum was trade war, right? What's next? Okay, the Fed doesn't cut rates. Big deal. They're still potentially cutting rates. Maybe they don't. That could be, I don't know. That could be a big disappointment if the market's going to realize like the Fed's not going to cut rates because yields won't go down. So we'll see. Let's see here. U.S. Steel earnings positive. Do you see? I mean, it's a tough one. X, to me, it's still a high price. I mean, CLF, I'm still holding CLF, and it's just a dog shit position. So CLF at 867. I still own shares around like $11, and I'm just holding on to them for hopefully a chance of this thing to pop back up. But I mean, you talk about like a value play. I mean, does CLF come back down to like $5 a share? I mean, if it does, it's hard to argue. Like, yeah, I mean, maybe there's a chance down here to get some love. But X, I mean, how many times did X? Wasn't this the whole like Nippon Steel? Like Japan was going to buy X, and it kept getting like smashed down. Like that merger, that buyout was not going to happen. We're trying to keep U.S. Steel as U.S. owned. I don't know. I'm not trading this upside. To me, I mean, if CLF is down that much, I'd rather see this thing get down to $30. I'd rather see this get down to $20. I might never buy the stock, but between CLF and X, I mean, I'll watch them. I'm not that interested in that space right now. Meta and S&P 500 look similar. Not really. I mean, I guess, but I mean, S&P looks like the S&P. I mean, Meta was down what 30+%, 35%. I mean, look, Meta looks like Mags. You want to talk about a correlation. There's your correlation. Meta is Mags, right? S&P is the S&P. Look, you don't have to have Meta be bullish for the S&P to be bullish. It helps, but S&P is gonna, there's 500 companies. It's not gonna be all driven by Mag 7. But Meta, we'll see. I mean, I think there's some lows, there's some highs. We might have a range trade here. Look, if we're offered multiple bottoms here, if Meta comes back down to lows, I'm going to take some stabs at it. If we're breaking up the highs again and this is a V bottom on Meta, I'm probably getting nothing out of this trade outside of the ratio spreads that I took earlier. That's it. Like I did multiple ratio spreads, trying to protect my levels like a 1-1-1 down here. Had 3 or 4 positions that paid really well. I did it on Meta, did it on Google. I'm doing it on Amazon. But I could see the market going sideways, right? Like we don't have to have direction all the time, you know? So I could see the market going sideways. Okay, earnings wise, yep, we got a lot of earnings today. So earnings after market today. Let me just do another screener. So let's go from today and tomorrow. Yeah, we have oh my gosh, we have 458 companies. What the heck? Let's put a screener in this. 178 companies. I mean, there's like 1,255 companies today with earnings, or this week with earnings. So there's just so many. Here's a good way to look at it. Look at today after bell. So today reporting after bell. Some of the notables. Palantir's after bell. Ford is after bell. HIMS is after bell. Realty Income is after bell. So these are some of the more like popular ones as far as the StockTwits community, and probably some of the heavier volume traded ones. Palantir is probably like number one. I priced out a Palantir trade. It's already had a ridiculous run for the year. I'm not going to try to catch the top or play. I'm not going to trade it. So I'll let Palantir do its thing. I've got ratio spreads. I've got other positioning on it, but took a nice trade on HIMS. Closed out a diagonal spread for a nice little profit. My max profit, I grabbed an extra 85 cents a contract, which wasn't too bad. But that's where we're at for today. So there's some notables in here. Lots of stuff to watch. All right. I think that'll do it for today's final hour. So daily profit layer running per usual. Waterfall, we put in a trade today on QQQ. Newsbreakers put in 3 fresh trades, App, Upstart, and Bill. Going to price out some more for the rest of the week if I can find a couple more. We still have some trades open on Robinhood and Amazon. So we'll still watch those to see if they hit some expected moves, and we'll see how earnings continue to develop this week. So appreciate everyone being here. Have a good rest of the day, and I'll see you all back here tomorrow. All right, thanks. Bye.